On the latest Masters in Business podcast, I sit down with Paul Zummo. He's Chief Investment Officer at JPMorgan's Alternative Asset Management. He co-founded this group back in 1994 with essentially pocket change. It now runs over $35 billion in assets for institutions and high net worth investors at JPMorgan. Really just a fascinating concept of everything about how to stand up a division within a large company, how to think about alternatives, how to recognize when an industry may be average, but the best players in that industry generate significant alpha. I thought this was fascinating, and I think you will also. With no further ado, JPMorgan's Paul Zummo. Paul Zummo, welcome to Bloomberg.
Thanks for having me. Great to be here.
I'm so excited about this because I just fell in love with your 30 Pearls of Wisdom. We'll get to that later. Let's start with your background.
Sure.
Bachelor's from SUNY Albany and then an MBA from New York University. What was the original career plan?
Sure. So, yeah, when I was young, I was always into investments, or at least intrigued by investments, but also into technology as well. Like, arguably, my to the extent we have a gift in life, it was probably technology. But the technology was so early stage, I didn't exactly know what it was. So I wound up pursuing obviously the investment side, but kind of used that technology from time to time, especially as we were building a group. But originally, I really wanted to get into equity research, and not that I knew exactly what it was, but it was the most like tangible and aligned with who I am in terms of problem solving and analytics and things like that, and wound up instead falling into the hedge fund world and doing what I do today is hedge fund solutions, which actually has a lot of elements in a sense of what equity research is. Again, you're problem solving at its core and doing analytical work.
You get the Chartered Financial Analyst designation, and you start at Chase as an analyst. What sort of work were you doing there?
Yeah, so out of school, I was in a pension fund consulting group. And so really what you're doing is a couple of things. One, performance measurement across client accounts. And also you're doing some research, manager selection on a traditional side. But I think what was helpful about it is it kind of gave you a really good purview of all different asset classes and all different styles of management. And I remember in the early days really appreciating like the importance of stylistic differences in equities as an example. This was, again, early days, but like recognizing, small cap growth versus small cap value and the drastic differences. But it really just set the stage to understand the industry in styles and types and approaches at a much deeper level.
So you were a manager of retirement plans at the Interpublic Group. Tell us a little bit about that.
Yeah, so after Chase, I spent about 2 years at Chase and then went to the Interpublic Group. So this is a plan sponsor and maybe a somewhat unusual move at that stage in my career. And what attracted me to it was they were at a point where they were, so again, this is an advertising agency, but I worked in the pension fund group, and they were looking to revise their asset allocation materially. So, change the whole asset allocation, change the manager lineup, and importantly, they didn't have a consultant, so they were doing it in-house. So they were affording me, not solely, but affording me a lot of responsibility to help restructure the whole plan, terminate managers, onboard managers.
What year was that?
So that was 1992 to 1994. And interesting.
I'm curious, what led them to say, hey, we're just going to start over?
Yeah, that was before. That was a kind of a decision that had already been made, and they were changing, again, changing their asset allocation and looking at the whole manager holistically. And interestingly, that's when I first got involved in hedge funds, or at least first met hedge funds. So this was, again, early days, right? 1992.
Everybody was producing alpha back then, right?
Well, then, yeah, then it was, that's true, but it was so unknown, So I met with a number of kind of market neutral equity managers, a couple long short managers, and then importantly, David Askin. So if David Askin, for those that don't know, was one of the first hedge fund, for lack of a better word, blow-ups, where it was a mortgage-backed derivative manager. and obviously a quirky-ish market, and wound up having significant problems. So it was, we did not invest with him, but it was really a very valuable early kind of lesson from a due diligence standpoint that obviously we didn't pay for, so all the better. But it really, like, I don't know, maybe tells you two things. I mean, one, if you don't completely understand something, and admittedly at age 24, I didn't at the time, then, stay away. Don't put money there, and then just have the courage to say no. There's a lot of choices out there, and you need to be disciplined and walk away. But we did invest in an equity market mutual fund, and again, that was 1993.
So that's the initial exposure to hedge funds. How did you go from there to JPMorgan?
Yeah, so this is probably another, never burn your bridges, which I'll come to. So I had, as I mentioned, I'd worked at Chase once before, and at the time I was looking to leave because once you restructure the plan, there's only so much to do, especially when you're young. So it was ready, to do something different.
You literally put yourself out of a job through the restructuring process?
Well, I mean, I could have stayed, but then you're just overseeing the investments as opposed to more actively. It's a little less interesting. Yeah. So in any case, I was interviewing at a hedge fund solutions, a fund of funds out of Long Island, and really liked the guys, a couple of great guys that were there. But at the end of the day, I decided I didn't want to go, I didn't want to reverse commute because I was living in a city and I didn't want to go out to Long Island. So I wound up not pursuing it. But the relevance of that is that what would become my boss, Joel Katzman, was distributing that fund of funds, and he was at Chase. So when it came time to do a reference check on me, they asked Joel to do a reference check on me because he was at Chase. I used to work at Chase. And the reference check, I assume, was good. But it turned out I didn't pursue it any further. And Joel, who was distributing the fund of funds at the time, got the idea of, rather than distributing it, maybe we should start this up anew. And if you want to work in a city, why don't you come work for me?
So you're at Chase, which even back in the early 90s is still a very large bank. This seems very entrepreneurial, very startup-like. What was it like building this division inside a giant money center bank?
Yeah, no, it was great. Bear in mind it was a different world back then in many ways, not only from an investment standpoint, but like what it takes to launch a new business. So yeah, we launched with a whopping $7.4 million, which is unusual to say the least.
Walking around, pocket money.
And I'd say, yeah, maybe a couple of things. So like from an investment standpoint, it was the perfect time to start. You had Orange County issues, you had rates going up, you had David Askin, as I mentioned before. You had dislocation, and that created opportunities. The problem was, not many people knew about hedge funds, and I'd say 3/4 of the people that did had a negative view.
Oh, really? So even in the early 90s? Because my bias is that the golden era of hedge funds was from the early 90s right up to the financial crisis. There's been far more challenging period post-financial crisis for alpha generating. The 90s, it seemed like everybody was making money.
Well, so two things. I mean, maybe we'll get to those points later about different cycles. But again, from an investment standpoint, people were making money. There's no question about it. I think the public's view, and partially like what had often been written in the press, was the negative side of hedge funds going after this currency or that currency. And I think the perception was one of, either it was negative or just a lack of understanding. So a lot of what we did early days was just educational. Like we would write newsletters internally and educate people on alternatives. But eventually, you put it together and performance kind of speaks for itself, and you build it over time. But it was great from an entrepreneurial standpoint. This kind of goes back to my tech side as well. I mean, one, building infrastructure broadly and process, but early days building technology as well. Like there was no per track, which was something people use. We and I kind of built it all. So built a research database, built a system to analyze returns, And yeah, that was great. It was a lot of fun.
So today, it looks like the industry is much better known. There's been a giant movement to try and democratize access to all sorts of alternatives, from hedge funds to private credit, private equity, real assets. What do you think led to this massive interest in alternatives? It's not like it's been a terrible equity market for the past 15 years.
Yeah.
It's been great.
So, yeah, two things. I mean, I'd say let's go back early days. Like, part of the vision, this was really, Joel's vision first and foremost, that alternatives were going to become mainstream, which, sitting back, and hedge funds were going to become mainstream eventually. And then, back in 1994, that was a novel concept. It was just this little thing off to the side. And look, we've more or less kind of arrived at that, right? So I think the vision is true. And then the second part is, well, why not retail investors, right? And if you think about 2022 and you think about rising stock bond correlations, there's so many investors, many of them more retail oriented or high net worth oriented, that just don't have alternatives or enough alternatives in their portfolios. So that's led to the democratization and launch of interval funds and tender offer funds, which is, I think, really interesting. So it's giving those investors access to alternatives, which are really valuable in an overall portfolio context. Right? So it's about building. Just to respond, like, sure, equity markets are going up today, but they didn't in 2022. And I think the takeaway is that you need to build a more resilient portfolio rather than just look at these things in isolation.
So you start with barely $7 million. Today, you have over $35 billion that you're directly overseeing. JPMorgan Chase is giant with trillions of dollars. It sounds like there's a whole lot more headroom for alternatives at JPMorgan to continue growing. Like, where do you see this going?
Yeah, I mean, alternatives are definitely the fastest growing, or one of the fastest growing areas within, and not just hedge funds, but more broadly. And there's a tremendous amount of support for it. So, I think, for us and for other alternatives, we're going to, continue to build, continue to launch new product, continue to, get a larger reach into, into other client types and geographies. The future is extremely exciting.
So I mentioned earlier 30 Pearls of Wisdom for 30 years. I want to dive into that in a moment. I have to start with one quote that kind of caught my eye. And we talk about this all the time. Culture is king. The road to failure is paved with poor cultures. Explain what led you to that conclusion.
Well, experience. I mean, I don't know. I mean, hedge funds fail and succeed for different reasons, but culture is definitely at the heart of many of it. And I'd say more importantly, like, sometimes people ask, what do you think about most as your takeaway, having been doing it over 30 years? Like, for us, for me, it's culture. Like, the culture that we've built as an organization has been spectacular and clearly a differentiator.
Is that what's kept you at JPMorgan Chase for 30 years? That's kind of rare these days. Most people don't stay at one shop almost their entire career.
Yeah, it's a couple things. I mean, culture and the team, it's like a family, for sure. And we make each other better. We challenge each other respectfully. We really enjoy each other's company and appreciate our differences. That's been great. Leadership at Jamie is unparalleled. So
Jamie
Jamie Dimon.
Oh, I've heard of him. Remind me to tell you a funny story about him later.
And then lastly, the job itself allows you, obviously, to meet with some of the best investment minds in the world, right? Which is just such a privilege. And then to be able to, like, dig in deep on so many different asset classes, so many different geographies, you're constantly learning. So those three things for sure.
I mentioned you're not exactly very public facing. You're a little below the radar, but you publish these really interesting things. And one of my favorite pieces you wrote was 30 Pearls of Wisdom from our last 30 years. We don't have time to go through all 30, but I picked a few that they're just so simple and yet so insightful, and we tend to overlook things like this. This one just jumped out. Don't buy the portfolio, buy the process. Stories change, positions are fleeting, but a robust investment process should endure.
Yep.
Like, that just sums up so much in 2 sentences. Tell us about that.
Yeah, no, it's definitely one of my favorites as well. I mean, it applies to like all different types of hedge funds, but I'd say especially discretionary macro, right? So you're interviewing a discretionary macro manager, and the vast majority of them are very smart. They tell a very good story. They have great views, but it doesn't necessarily mean they're a moneymaker, right? And again, I think sometimes people make the mistake of agreeing with the view, agreeing with the manager, getting seduced by someone having insight, and obviously it's really important, but again, it doesn't necessarily speak to the process, and especially in something like discretionary macro, where it's not a high sharp strategy. It tends to be a more volatile strategy, and if you don't develop that conviction, and again, first and foremost in the process, you can get shaken from that idea, right? The ideas change, the process should endure. So really, really important for sure.
Have the courage to make mistakes, mitigate unnecessary risks, but take calculated bets. Again, 2 simple sentences, so much involved in that.
Yeah.
I find a lot of people in our business don't like to admit mistakes.
Yeah, I think it's something, not the admitting mistakes so much, but the courage to make mistakes. When I think about
take a risk, a calculated risk.
When I think about like things that I've done better over the years, that is definitely one of them that comes to mind, where I've given myself more freedom to make mistakes and to maybe size and lean into themes or high conviction managers to a greater degree as well. Where I think maybe there's a perfectionist in many of us, and sometimes the flip side of that, or the problem with that, is you become too conservative, right? So now, yeah, if you make a mistake, you need to figure it out quickly and change course. But allowing yourself to maybe make mistakes is definitely helpful.
I really like this. Don't be afraid to run into fires. Some of the greatest investment opportunities and manager access are sourced during dislocation. Tell us about running into fires.
Yeah, so this is obviously really important. Like I love behavioral issues and behavioral finance and like the challenges that come to that. And of course, we're all wired, inappropriately from an investment standpoint, and that we're wired to avoid pain, which is why many people make the wrong decisions during periods of crisis or periods of heightened volatility. I think some managers do a great job. I wrote it about, I guess the manager I had in mind was David Tepper.
Runs into fires all the time.
Yeah, I mean, it's kind of, less so these days, but
Right.
certainly over his
He moved to Florida, kind of chilled out a little bit.
But he always, again, having watched things play out over 30 years, I always thought he did, he's done a really good job. But, and again, like this is something I think we've done a better job at over time as well. When I think about, the crises, 1998, 2008, 2020, as they say, many of these things rhyme, and you've seen it before. Like, you know what it feels like kind of coming out of it and going in. And if you're playing the appropriate defense, like you should afford yourself the opportunity to really lean into where you think there is dislocation, especially more technical oriented dislocation. So yeah, it's critically important. I mean, that's where you make outsized returns during those inflection points.
So let's talk about outsized returns. Success can be a dangerous achievement. Complacency, distractions, and misalignments can be silent killers.
Yeah. So I guess you could come at that one from a couple of different ways, but one of which the most important is like when you find success, sometimes people, the firm grows, the number of analysts grow, the complexity of the business grows, and the portfolio manager goes from managing portfolios to managing people. And, like I've seen that movie so many times. Like that,
maybe they have that skill set, maybe they don't.
And maybe they don't. And that's probably not where you want them to spend their time, So I think, like, if you think about the hedge fund graveyard and, like, what the issues have been over this, like that, there's a big area that kind of has that footprint, if you will. So, yeah, people, the star portfolio manager no longer spending the appropriate time on a portfolio, managing people, getting distracted. Or the second piece of it is just, quite frankly, making too much money, right? So, when I bought the third yacht,
I was about to say
it's time to leave. It's probably time to leave before the first yacht. But
the first time I heard that has to be like 20, 25 years ago. Hey, when your fund manager buys a 40-foot or a 50-foot boat, it's time to move on.
Yeah, I mean, it's more than that, but yes, you have to you have to watch the personal lifestyle at times as well, and make sure people are focused. Now, there are people that are billionaires and they're still in the office 70 hours a week, right? Mm-hmm. And it's just innate. They couldn't do anything but that. But yeah, you have to you have to understand what am I buying. And maybe it changes, right? So maybe that star portfolio manager's built out enough of a team, and you're not buying anyone singularly. You're buying something broader, and that's
process
supported,
you
right?
mentioned earlier.
But yeah, it's a risk for sure, and it's an area where many of successful hedge funds have kind of either become potentially mediocre or have had challenges because they've taken their eye off the ball in one way or another.
Really, really interesting. I love this one. The opposite of long isn't short. Great short sellers are wired differently. Don't expect success on the long side to necessarily translate to a successful short book. First, I love the quote. Second, are there really any short sellers left? I think this last run feels like they steamrolled over everybody.
So, yeah, maybe a couple things. So, I mean, just on the quote itself, I have to, of all the lessons learned and all the mistakes we've seen people make, that one is probably right at the top, or certainly right toward the top. Like the opposite of a long is definitely not a short, and sometimes people will suggest it is. I mean, the math is different, risk management is different. The timing is different. Like I would even say successful shorting is about risk management first and stock picking second. And you see that. I mean, you've seen that when in 1999 when the internet is going nuts. You see that in the meme stocks. You see that today with quantum computing and some of the AI names. Again, it's risk management first, stock picking second. Timing is timing and sizing is just critically important. Go ahead.
I was going to say I have a buddy who used to run a hedge fund trading desk, and he always used to say, the opposite of love isn't hate. The opposite of love is indifference.
There you go.
And it's the same basic, and he was talking about stocks, but it's the same sort of thing. They're not mirror images, are they?
No, definitely not.
Are there any short sellers around? I know 130/30s have become popular.
Yeah,
and a lot of quants approach it that way.
So maybe there's two different aspects of it. So there are successful and good short sellers out there. I'd say there are less that are dedicated short sellers. So from 1995 to 2008, we used dedicated short sellers and short bias managers, and it was really interesting and actually a tremendous source of overall alpha. After 2008, we no longer use dedicated short sellers and short bias managers, so I don't follow the space nearly as much. But there are certainly good ones within long short equities. Maybe I'm sure there is some on a standalone basis. It's a very difficult business model.
Tough gig.
One of the interesting things in short selling, which I think people don't, I don't know, I've never heard it spoken about before, is and this is dated, but when you looked at, again, let's say pre-2008, where there were probably, I don't know, there's certainly a few dozen dedicated short sellers and short bias managers. I want to say 40% of them were women.
Really?
Which people don't.
That's fascinating.
So Charlotte Hughes, Stephanie Ross, Dana Galante, all these very successful short sellers. And in an industry that was more male-dominated, it always struck me as just really interesting that in that segment, that an overwhelming amount, at least on a percentage basis, maybe it wasn't greater than 50%, but
compared to the rest of the industry, it was outsized.
It was outsized. It's just interesting.
There have been a number of academic studies that say female fund managers outperform their male counterparts by anywhere between 50 and 100 basis points. And it's always, the joke is testosterone poisoning. But It's fascinating to hear. I'm curious as to why female short sellers. Is it an objectivity? Is it just a different approach? It's kind of really intriguing.
Yeah. Well, my wife would probably say it's because they don't have the egos of the men.
Right,
you
right.
know?
That's
so,
the poison.
Yeah,
It's absolutely.
Right.
If it doesn't work out, they cover it and move on.
Yeah, I think there's probably some, of course, there's great examples of both, but again, risk management and discipline is definitely the key to successful short selling. So there has to be something about it.
Let's go with another bullet point that speaks directly to that. I love this one. Avoid casinos. Black isn't on a roll and red isn't due. Very few managers add value over time through timing the market, even if it sometimes looks like it. Don't reward a manager for gambling.
Yeah.
Again, so much insight in 2 sentences. Explain how you reached this conclusion, which I just think is brilliant.
Yeah, so I give credit to Chris Marshall on the team. I think he's the one that came up with that quote. But it really, again, is the observation that the vast majority of managers are let's just take long-short equity managers. The vast majority of them are good stock pickers, but bad portfolio managers. And
Two different skills.
It's
two very
different skills.
Yeah.
And timing decisions, the vast majority of managers are subtracting value from their portfolio management
Really?
decisions.
You're going to say top quartile, top decile? Where's the alpha coming from?
I mean, the alpha is coming from, like if you look at, let's put it this, if you look at fundamental long-short equities that live within the pods, and you look at alpha generation with them on a turn of leverage or whatever you want to say, and then you look at the standalone long-short universe and the alpha that's generated there, there's a disconnect. Right, and it's not because they're not good stock pickers. The disconnect, I think, is because the bad portfolio management or subpar portfolio management is subtracting value from their stock picking. So maybe they were adding 5% of alpha in the stock picking and decaying that by 3% from portfolio management decisions. And I just think it's difficult and. There's been tremendous factor moves in the last number of years. There's also issues when you're operating on a standalone basis, like there's business considerations, rightly or wrongly, right? So if someone's operating in a 10 vol and markets are going down and they're, in the hole by 8%, now are they acting differently from they should be buying a lot more because the markets are down and things look interesting, but are they?
They're playing scared.
They're playing scared, and I think it's, again, it's not everybody for sure, and there's some that do it well. I just think it is very challenging to do. It's much easier to find good stock pickers that are adding alpha than it is for someone to consistently be able to make, contrarian or correct portfolio management decisions.
The old joke is the crowd is right most of the time. So if you're constantly fighting the crowd, you're on the wrong side of the trend.
Yeah, there you go.
Last one, and again, another brilliant one. Dinosaurs go extinct. Innovation must be constant.
Yeah, and this is for hedge funds as well as us, and and part of it relates to the managers themselves, part of it relates to strategies, and again, part of it is business model. But when I think about strategies that we used to invest in 1995 where you can make a lot of money. Like, let's take merger arbitrage, like merger arbitrage, again, you could make double-digit returns. It was less competitive.
Plus, you need mergers.
And that helps for sure. But now, like the strategy, I mean, there are some very successful people that do it on a standalone basis. Usually they do it with credit or other events, but like it's a much more difficult place to make money. It's become largely commoditized. When it becomes interesting, there's a swarm of money that will kind of go into it, right?
Isn't that true for every style, every sector?
Well, eventually, which is why you need to innovate. You need to, so let's take, like machine learning quant, right? Like machine learning quant, started investing 10 years ago, like, that was novel, and today it's obviously gaining a lot more momentum. People understand it more, but you have to kind of continue to reinvent. Like from our perspective, need to continue to look after different strategies, different types of managers to find kind of high alpha, and then from a manager standpoint, again, let's think about quant again. The managers need to reinvent themselves. and refine themselves from an alpha standpoint. So like alphas decay. Yesterday's alpha is tomorrow's beta, right? Mm-hmm. And a lot of what has made them successful from an alpha standpoint is going to decay. So if you don't, maybe it's 15, 20% is going to decay and be irrelevant each year. So you need to constantly kind of reinvent yourself.
So when you start putting together the next 30 over the next 30 years, yesterday's alpha is tomorrow's beta. That's number 31 for you.
There you go. That's right.
So let's talk about what's going on today. Hedge funds have had to adapt to a very challenging era, certainly since the financial crisis. I've heard financial repression and all sorts of reasons for why some funds have been underperforming, less volatility, increased dispersion in equity returns. What's going on in the world of hedge funds today?
So, yeah, the last 5 years especially have been a great time for hedge funds. So let me maybe frame it. And actually, we just came out with a paper called "Hedge Funds and the End of the Alpha Winter." And I should do a shout out for Emmy Hodges, who did a great job on putting the piece together. But maybe just taking a step back, we identified kind of three big picture variables that really drive excess return in hedge funds. Mm-hmm. So one of them is volatility. Everything else equal one vol higher. That creates dislocation, sloppy trading. It's
opportunity.
Opportunity. It's the fuel of what drives alpha, right? The second is dispersion. So equity dispersion first and foremost, but wider dispersion as well. So more winners and losers. Obviously, if you're a stock picker, that's helpful. Mm-hmm. And the third is rates being higher than 2%. And higher rates help in a number of ways, but both kind of mechanically, if you have floating rate debt, it's helpful, higher rates. But also, again, we've seen this like in a period of rising inflation where rates are going higher, that's going to fuel increased volatility, so it's a little circular, right? But elevated volatility, or at least normal volatility, elevated dispersion, and rates that are greater than 2%. When you have those three elements, so even two of those three variables kind of as a tailwind rather than a headwind, alpha generation is really, really strong. So what we've done is we looked at three different periods. The first starting with 2000-ish, kind of a 10-year period. I forgot the exact percentage, but like a large percentage of the time, two of those three variables were at your back. They were helpful. And you saw excess return that was very, very high. The middle period, which is the alpha winter, you had the
2010s. Is that what we're talking about, essentially?
Yeah, to 2010, right? The middle period, which is I think 9-ish or year, 8-9 year period, which admittedly is quite long, was one where you saw a lot of central bank intervention, where those variables were generally, depressed. You could think about 2017, realized vol being really low. Obviously, we had rates at zero for a chunk of that period as well. That was difficult to generate alpha, not only for hedge funds, but more broadly, and that's kind of the alpha winter. We would suggest that period is abnormal, and, even if rates go down, even if vol comes down, you're not likely to go back to a period that's so dominated by that period of central bank intervention. And, most importantly, the postscript to that is for the last 5-ish years, you've gone back to kind of the good old days of alpha generation, right? So the last 5 years, you've had volatility that's, generally normal or higher, dispersion that's really high, and rates that are accommodative as well. And excess return on alpha has resumed and looks very much like what it looked like 20 years ago versus that kind of middle alpha winter period.
So the past 5 years have been really interesting. 2022, obviously, stocks and bonds down double digits. That seems to happen once every 40 years or so.
Yep.
What about 2025? What sort of role is deglobalization and shifting trade policies playing in shaping hedge fund returns?
Yeah, I mean, obviously you have a lot of different, it's a lot of different strategies, a lot of different sub-strategies. So it's very difficult to talk about the whole hedge fund industry
right.
as one thing. But when I think about excess return, all the things that you mentioned are generally good for hedge funds, right? Mm-hmm. So the rest of the world is getting worried. That is, again, the fuel of what drives hedge fund returns, right? So when you see when you see rising vol, and that's going to be good from statistical arbitrage. It's going to be good generally for balanced stock pickers. It's going to be good for discretionary macro managers. When you see deglobalization and some of the trends that come out of that, whether it's onshoring, whether you see some of the moves in gold and like that, that's good from a trend following standpoint. It's good for discretionary macro managers. When you see Japan increasing rates, the U.S. decreasing rates, that's hopeful because it's two bets. Discretionary macro managers can place. It's not just like everyone operating in the same way. So those things are good. I mean, generally because it gives people more of a palette to, an alpha palette to which to choose from, place more bets, diversify more. And also heightened volatility and heightened uncertainty is going to be positive for the vast majority of strategies, especially from an excess return alpha standpoint.
So you mentioned Japan. I'm curious what regions around the world are attracting the most new capital. We've seen Europe suddenly catch a bid.
Yep.
Obviously, Japan has been doing well. The rest of Asia, the Middle East, and even the U.S.,
Yep.
What areas are attracting new capital and what's driving that trend?
Yeah, I mean, one of the areas that we're most excited about for sure and have been leaning in for the last few years is Japanese corporate governance. Now, interestingly, if you look at dollar flows into Japan, it's actually not, I mean, it is positive, but it's kind of modest in the grand scheme of things, which kind of shocks me, honestly. And like, I don't mind because we're playing events first and foremost. But you really haven't seen that many dollar flows in, which again is unusual given like everyone in the world in every way, shape, or form is probably underweight Japan, and it's obviously inexpensive. But most importantly, you have a material, dramatic catalyst that's driving value through Japan. And yeah, we're excited about it. I mean, corporate governance has been talked about in Japan for decades. The reality is until Abe had his third arrow, and which really set off a number of regulatory and policy changes, and importantly, like cross-shareholder relationships started to unwind. That really set the stage for increased corporate governance. So it's we've been there for 3 years. I think we're maybe halfway through what needs to be done, and there's still a very, very fertile opportunity set. So that's one. The other thing I would point out is just the Middle East. Now, obviously, it's not to say that there's a lot of money from an investment standpoint going into the Middle East, but I had just come back from a week-long trip in the Middle East, and got there maybe 18 months prior, and it's really exciting what's going on. I mean, clearly there's a lot of interest from an investment standpoint in hedge funds and alternatives in the Middle East. There's no question about it.
Is this because all the sovereign wealth funds located in Qatar and Arab Emirates and go down the list?
It's
Dubai?
coming. It's certainly coming from them, but it's broader. It's broader as well. I mean, it's family office money in addition to the sovereigns, and they're interested in alternatives. They're interested in hedge funds.
Local family office or Europe and American family office in the Middle East?
All of the above. I mean, there's also been, which is maybe to tie together one other part. I mean, there's also been a lot of movement of people, of hedge funds setting up businesses in Dubai and Abu Dhabi, and people moving there with wealth, and in turn they become, potential investors in alternatives. So that's definitely a prominent story as well. The number of people that are setting up in the region or opening up offices.
So when we used to talk about New York, London, Tokyo, Hong Kong as centers, do you put Abu Dhabi or Dubai in that list? Is the Middle East?
It's for the larger hedge funds for sure. I think it's becoming the vast majority of them are opening offices or have offices in regions. So it is definitely an area that is attracting a lot of interest. And then from an investment standpoint, again, it's a much smaller market, but I think the policy changes and regulatory changes, which allow foreign ownership and a derivatives market starting, is encouraging as well. It's early days, and again, it's not the breadth and depth of the market still needs to improve, but again, it's exciting from that standpoint as well.
Really kind of intriguing. What are hedge funds thinking about with assets like crypto or gold? How are they dealing with what are some of the biggest winners past couple of years?
So you've seen, I mean, on gold and precious metals, I mean, discretionary macro managers have, many have had that bet on. It's been a very successful bet and theme, given, concerns on inflation and debt levels. So you continue to see that theme in people's portfolios. Crypto is a little more interesting and specific. Some managers, again, mostly discretionary macro managers, have invested in crypto, mostly Bitcoin or ETH, more from that inflationary, debt standpoint. Although others have from other standpoint as well, from like a trend following standpoint on futures, people have done it. A bit on statistical arbitrage side. Some people play from like a cash future standpoint, from an ARB standpoint as well. But it's still small, at least let's say the traditional hedge funds investing in crypto, it's still small. That being said, obviously you have a large number of like dedicated crypto funds that are trading both directionally as well as on the ARB side as well.
So what styles in hedge fund worlds are doing well in 2025? I've noticed over the past few years, emerging managers have made some consistent gains. Quants have done well. Some of the multi-strats have done well. What are you seeing in the rest of the field, some of which, even in this high volatility, high alpha market, have been struggling?
Yeah, I'd say so. We look at Pivotal Path as their indices first and foremost. I think it's they're very, very good quality indices, and I think paints a very good picture. And that's kind of what I have in mind. So like when you look at it, you'd find that most strategies and sub-strategies have done pretty well this year in the grand scheme of things. The one exception to that is CTAs, which have struggled.
Even with gold running away and...
CTAs got hurt in April, where they were very, very long equities, and yet Liberation Day, and the markets correct a lot. So you saw a bit of a retrenchment in CTA's performance in April. They got hit pretty hard, and they've been trying to like piece it together. And they have the last couple months have been stronger.
To be fair, it's very challenging to follow a trend when the trend is dependent on the whims of one person.
That is true, for
right?
sure.
Doesn't show up.
But the good news is most other strategies are actually doing quite well, right? So if you look at across relative value, as you mentioned, quant, the multi-strat pods, convertible bond arbitrage has been good with strong issuance. Discretionary macro, as we talked about some of the themes, whether it's gold or rates themes, has done well as well. Long shit equities has done well, and you might say, okay, well, the markets are up, but it's not just beta, it's alpha. So a couple of people have come up with, if you look at the alpha generation this year, it's about 5%, 5.5% in long short, which is quite healthy. And even, merger arbitrage events done well, credit's done fine. So I'd say it's been a good year overall, with most strategies generating, strong kind of mid-single digit to high single digit returns, or high single digit returns, and overall definitely a good year for the industry.
So we've seen the rise of multi-strategy managers over the past few years, and there have been a number of very large multi-strats, and it seems to be a direction a lot of funds are heading. How has that changed competition within the industry? Is there more collaboration within a multi-strategy shop amongst all the different pods? How is that playing out?
Well, I think collaboration amongst themselves. I think there's a pretty...
I'm assuming they're not competing, they're not collaborating with the fund across the street. It's all internal, right?
I'm sorry, collaboration for the pods, to pod, or within the pods?
Collaboration within a multi-strat from, hey, here's the macro, here's the long short, here's the quant group, here's the trend group. What are we seeing?
So like cross-pollination across teams. I think it depends on the model. Like if you look at the pods, obviously there's some prominent ones out there. They differ materially from like strategies that they pursue. They differ materially from the culture that they pursue. They just differ in the risk management approaches is different. So it really depends. There are some managers where they are benefiting from maybe cross-pollination. Across teams, or a center book that's maybe drawing upon best ideas. So, but it's really going to differ kind of pod to pod based on the style and how they operate.
Fair enough. Let's talk about risk management. There were obviously some lessons learned this year in April, and plenty of lessons learned in 2022. What do you think are going to be the most impactful lessons for managers looking forward?
Looking forward. I mean, things we're worried about today is just complacency. You know, I mean, anytime you have markets going up for a while, inevitably complacency develops in some way, shape, or form. So we're certainly being, front-footed and having discussions. Where is that, and whether it's credit or equity markets, and like how do we, or specific areas with hedge funds, and how do we guard against that a little bit. But I think some of the events last year, like we're talking about, Liberation Day or maybe the DeepSeek event, and some managers being,
God, was DeepSeek 2025? It seems like years and years
maybe
ago.
It was,
No, it was. It was January this year. It blew everybody's minds.
I think it really underscores a couple things. I mean, one, risk management first and foremost, right? And certainly on Liberation Day, I think a lot of people were caught off balance in their books. And then again, oftentimes kind of retrench after that, locking losses. It's not a great recipe. So like sizing positions and sizing risk across areas, in which people invest are obviously always critically important. And then on DeepSeek, look, AI is extremely exciting. It creates tremendous opportunities, but going back to what we were saying about short selling before, it also creates tremendous risk. And, risk of just being one-sided bet, but also risk of, again, operating on a long-short fashion and thinking about like offsetting risks and basis and sizing. So those things are critically important.
So speaking of AI, I just overheard Paul Tudor Jones speaking to somebody on Bloomberg saying, maybe AI might be developing into a small bubble, but it's not a giant headache. How are you looking at all this bubble chatter, high valuation, concentrated markets? This seems to be part of the wall of worry that markets are climbing. What's your perspective on this?
I mean, if Paul said it, it must be right. So
you could do worse than following Paul Tudor Jones.
That's right. I mean, look, is it a bubble? Obviously, it's real. It's going to be impactful. It's going to be enormously important. It's going to reshape how we do so many things, for sure. Is there excess in certain areas related to it? There has to be, for sure. I think it comes down to risk management first and foremost. Assuming you want to set up a balanced book, it comes down to risk management first and foremost. And if you just want to play it from a thematic standpoint, again, it also comes down to risk management just from a sizing standpoint. You need to size it to be able to handle the inherent volatility of it. But is it rich? Well, of course it's rich. Is it a bubble? I don't know. I'm not the best one to say, but it certainly is real. It's certainly going to revolutionize and change our lives.
Every time someone asks me about it, I like to remind them Greenspan's irrational exuberance speech was 96. He still had a long way to go before that really became a bubble.
But also, look at, we're talking about, .com, right? So, I mean, as a little bit of your model and your playbook, right? So, I mean, obviously Amazon came out of that, but there's a lot, pets.com, dating myself, but and I have
Metro Media Fiber,
I have the
Juniper
stock
Networks.
puppet on my desk.
Really?
It's going to be there's going to be winners and losers,
right?
And it is extremely important, extremely powerful, but it's not going to lift all boats at all times. So you need to be selective and you need to size it right.
Makes great sense. Last question before we get to our favorite questions. What do you think hedge fund managers and investors are not talking about, but really should be? What topics, assets, policies are getting overlooked but shouldn't?
Well, I mentioned complacency a little bit just because where we are in the cycle, but maybe if it's okay, I'll take it in a different direction to say like it's more of a misnomer about the hedge fund industry, which is, if that's okay, it's a little different. So one thing I would say that's frustrating, I think a lot of people get wrong, is they look at the hedge fund industry as an asset class. And what I mean by that is if you have an asset class, then everything in an asset class should be more or less highly correlated to each other, right? It's the same thing. And if you take the 10,000 or so hedge funds that are out there, the correlation, the cross correlation, pairwise correlation is something like 0.2 or 0.25.
Nowhere near one.
It's nowhere near one, right? So what you really have is a collection of strategies, a collection of sub-strategies. Importantly, the characteristics of those strategies are just vastly different from each other in many cases. And the way you use them in a portfolio is vastly different. So when people think about the hedge fund industry and they're looking at like a hedge fund benchmark, which is, or like 10,000 funds cobbled together, oftentimes they look at it and they're like, well, I don't know what to make of this. It has an okay return and an okay volatility with okay characteristics. Maybe I don't need it. And it's the right conclusion to the wrong answer, right? Oh, I'm sorry, the right conclusion from the wrong question, right? And like, again, the observation's correct, but really the question is, can I look at subsets of this industry that are deeply valuable rather than just looking at the whole thing as a whole? And we would strongly suggest that if people are just looking at the aggregate industry, they're missing the point that beneath that there are strategies and sub-strategies and certainly managers that are adding enormous value that's being overlooked by, someone who's plugging the average into an optimizer.
I'm so glad you said that, because over the course of 25, 30 years, I've watched the hedge fund industry change so dramatically, and my own views on it have evolved. It's very easy to look at a broad index and say, gee, this is expensive and doesn't generate great returns. But again, depending on where you want to draw the line, top quartile, top decile, when you look at the top performing funds, there is genuine alpha generation.
Yeah,
there.
for sure. And interesting, like if we would have met, 25 years ago, 15 years ago, like I would have said the same thing, is that like I'm not here to say the hedge fund industry as a whole is such a tremendous value proposition. Like that was never the thesis. The thesis is more, are there 100 or 200 managers out there that are adding enormous value? Yes. And, can, through great due diligence, like can myself and other people find them if they spend the time and do a great job? Yes. And is that tremendously value in portfolios? Yes. But it's not about the hedge fund industry as a whole. And the averages are gonna knock the lights out.
Jim Chanos has this quote I love. He says, when he started out in the late 80s, early 90s, there were a couple of hundred hedge funds and they all generated alpha. Today, there's 11,000 hedge funds and it's the same 200 hedge funds generating alpha, which, there's a lot of truth to Sturgeon's law. There's a lot of truth to 90% of everything is not great.
Yeah. Yeah, I don't know if it's the same 200, but
no,
yeah,
he said the same number, not necessarily the same funds. They come and go.
Yeah, look, it's an industry and an asset class and a fee structure that attracts a lot of people, but and many of them deserve that fee structure, and many of them are great. But yeah, obviously, you need to be selective.
Absolutely. All right, let's jump to our favorite questions that we ask all of our guests, starting with, tell us about your mentors who helped shape your career.
Sure. I think, so two come to mind. I mean, if I go back really, back to high school, and I'm forgetting his name. It's my wrestling coach.
I swear to God, I knew you were going to say that.
It's my wrestling coach, who was my economics professor. And this is when I first started getting interested in investments and started reading, I don't know, some of like the classic books from way back when. One
Reminiscences
of Wall Street, Reminiscences of a Stock Trade, Right. And he was the one that kind of encouraged, and we actually played this game at the end of the year, which was like a stock market game, and I actually found an arbitrage, and we made more money than anyone had ever made, And he's like, that's kind of like real life finance. You should, if that interests you, you should explore it. So I credit him for kind of helping push me in that direction. And then from a career standpoint, I mentioned Joel Katzman, who hired me to, start the business with him. And yeah, he was really instrumental. I mean, one of the things I don't think we spend as much time, but like skepticism is really important. I'm a deeply skeptical person. I think it helps you navigate things. It's one of the pearls of wisdom. Joel,
be a skeptic, approach due diligence from the perspective, where does this break?
where does it break? Yeah. And I mean, it's like approaching due diligence. I give an analogy of like thinking about a balance sheet where people, again, behavioral biases, you know, too many people say, approach it from the asset side. How much can I make? What's the story? You need to approach it from the liability side. Like, what can go wrong with this manager? What can go wrong with the strategy? Where does it break? And then turn to the asset side and effectively say, am I getting compensated for that, right? And you could teach people some of that, but part of it has to be innate as well. Like, you need to be an innate skeptic, maybe. So, any case, Joel, I think shared my skepticism for sure. He certainly taught me a lot about the business and running a business. So, props to Joel.
Let's talk about books, since you mentioned some books. What are some of your favorites? What are you reading currently?
Yeah, so books. So we invest in around 120 hedge funds, and
that's what you're reading.
The vast majority of what I'm reading is their letters, their research. My analyst research, and that's the vast majority. And then like Michael Semblas does great work.
Yep, love his work.
Really good work. So I have to say that's consuming the vast majority of my time. The only thing that stands out, there's a book. What is it? Speak Like Churchill and Stand Like Lincoln that my old boss Jamie Kramer gave to me, which is about public speaking, which is actually really good, insightful, like easy read book.
Speak Like Churchill, Stand Like Lincoln.
Yeah, and it's a real easy read to just some like reinforcing some good lessons of public speaking.
You mentioned Michael Semblas. So I consume his regular output, and then the JPMorgan quarterly guide to the markets is just
Great
a
pieces.
spectacular resource.
Agreed.
Really find it amazing. Let's talk about what's keeping you entertained these days. Are you watching or listening to anything interesting?
Like Netflix and
sure.
So. Yeah, well, I have a 5.5-year-old, and so she's dominating the Netflix account. Usually, it's the K-pop Demon Hunters.
That's the number one thing on Netflix
guess so.
now.
I was going to say, I don't know if you know what that is.
Every time I'm searching for anything, I put it on for 30 seconds, and my wife is, "What are we watching? Can you take this?"
Yeah.
off, please?
So unfortunately, it's a little too much of K-pop Demon Hunters, but away from work, I like wine. Mm-hmm. So it's probably some podcasts or related to wine, just when I'm not reading the manager notes. So, but there's a great one called Wine with Jimmy, which is
Wine with Jimmy.
If you want to do a deep dive on wine,
yeah.
I
literally just bought I forgot the name of it, but during Amazon Prime, it was on my wish list, and it was like $98, and it showed up for $30. The Atlas Guide to Wine Around the World.
That's a fat book.
Fat, and I'm like, all right, that's absolutely worth having on the dry bar.
Now you have to read it. You look good. You look smart with it.
Absolutely.
At least.
It's more of a reference guide, but. Give us some of your favorite wines. If you're not going to give us more books, give us some wines. What do you What do you drink? What do you like?
Well, this is. I like red more than white. I like like a Barolo, so a nice tannic red. Red wine. So I drink Barolo, Tempranillo.
So we're always looking for a house wine, just like something reasonable that you could pop open any time. This Intre Natale Verga is about a $20 bottle, and it drinks like a $50 bottle.
Nice. Finding those values. Where's it from?
Italy.
Okay.
But they only, like, it's a small winery. They make a few thousand cases. You can't get, like, I'll get a case and that's it. You're done until next year.
We'll swap great value wines after.
There was another one called Xanthos that was a Meritage, Xanthos.
Okay.
And the 2017 was spectacular. You can't find anymore.
Yeah.
It was like a $15 bottle of wine. Drank like a $50 bottle of wine. I don't feel like I have a palate to go much beyond that? Like, all right, I appreciate.
Listen, if you could find $20 bottles of wine and
Yeah.
drink like $60 wine, but you know,
My
I have I'm forgetting the name, but I have a Sangiovese like that.
Yeah.
Which I found at one of the wine. You know, you go to these like wine tasting events, but you go around and you could taste
blind
a bunch of
tastings, right?
It could be blind, but this is like a James Suckling one where
Uh-huh.
you taste all different types of wines and then you I don't know. For me, I take pictures of the ones I like, and then you go back. And then you look it up, and some of them are like $150. And you're like,
Right.
oh, I didn't find anything. And then you see one that's like $20, and you're like, all right, maybe I found the jewel.
Right.
Um,
It's easy to get disappointed in a $150
Yeah.
bottle of wine at $20. It's
But there's a lot of great wine out there.
and then you go to Italy and you sit at a cafe and you get an $8 carafe and it's the
And
best thing
it's
you've had.
spectacular,
Right.
exactly.
It's just so crazy trying to figure
Totally.
that out. So our final two questions. What sort of advice would you give to a recent college grad interested in a career in either investing or hedge funds or alternatives?
Yeah. So, I mean, first, and I guess it's cliche, but like the do what you love thing is so real and valuable. But I think you have to like find what you love first. Like when you're 20 years old, I don't know that anyone.
It's a big world.
Yeah, like has a great vision on it. I would say like trust your instinct. So like it's obvious to me today why I'm doing what I'm doing. It's like this is. I don't know. I'm skeptical. I'm structured. I'm creative. I'm like curious. Like it makes sense today. It didn't make sense completely at the time, but like you follow your instinct. You're like, oh, I love to do this. So I'm working on the weekend every week because like this really intrigues me and it's interesting and like they I don't know they could not pay me and I'm still doing this, right? So like I think being true to yourself and really exploring like what makes you happy, what makes you intrigued, what really makes you dive deep on things, and then continuing to lean in and continue to pursue it and learn more and more. Maybe the second part of it is just be a student of history. So I like baseball and I think like when I was young, like how much I learned about the Ty Cobbs and DiMaggio and Ruths and everybody. Like I think if you're a baseball player, like you should know the history. If you're going into the hedge fund industry, like you should know the history. When I say David Askin, you should know who that is. So like take the time to understand the history because I mean, a number of reasons. One, it gives you context, but two, like the mistakes and the opportunities often rhyme with each other, right? So like how do you like investing in 2020, in March 2020, turns out it looked a lot like 2018, 2008, 1998, like there were elements that are very, very similar, and being a student of history helps you navigate much better in the future.
To say the very least. Final question: what do you know about the world of investing and hedge funds today that would have been useful back in 1994 when you were first launching JPMorgan alternative asset management?
I mean, there was no internet, right? So
Right.
I mean, yeah. So back in 1995, I mean, I don't know, we knew a fraction, we knew 5% of what we knew today, but it was 50% more than the next person knew, right? So, I mean, it's all about getting an edge and continue to reinvent yourself. I think the biggest lessons learned for us, but for the industry is, and what I would have taken back if I could, is just the depth of understanding on financing. So, in financing agreements, right, like prime broker agreements and term and triggers and all sorts of things that have caused problems over the years. If you could take that one, and it's caused a lot of, pain historically from time to time. I mean, if you had that knowledge and you pull that back to 1995, wow, you would be able to, navigate seamlessly across the industry in a way that, was much bumpier for everybody along the way.
Paul, thank you. This has been absolutely fascinating, and thank you for being so generous with your time. We have been speaking with Paul Zummo. He's Chief Investment Officer at JPMorgan Alternative Asset Management. If you enjoy this conversation, well, check out any of the 600 we've done over the past 12 years. You can find those at Spotify, iTunes, Bloomberg, YouTube, wherever you find your favorite podcasts. And be sure and check out my new book, How Not to Invest: the ideas, numbers, and behaviors that destroy wealth and how to avoid them wherever you buy your favorite books. I would be remiss if I did not thank the crack team that helps put these conversations together each week. Alexis Noriega is my video producer. Anna Luke is my regular producer. Sage Bauman is the head of podcasts here at Bloomberg. Sean Russo is my researcher. I'm Barry Ritholtz. You've been listening to Masters in Business on Bloomberg Radio.